Welcome, everybody. This is Axel Merk. I'm the President and Chief Investment Officer of Merk Investments. And as usual, I'll give my in-between-the-line readings of our most recent chart book. This is on the US business cycle. Nick Rees, our Senior Financial Analyst, is the driving force behind these charts. And I encourage everybody to listen to his analysis as well. He has more of a cut and dry analysis. I provide, or at least try to provide, more of an in-between-the-line reading. And also, for some of you are not aware that you can download the PDF of these chart books at merkinvestments.com/research. Sometimes it's easier to look at the PDF than look at the video. The resolution is higher. And the text that's underneath these charts is written by Nick. And the goal here that Nick has is to provide a consistent set of charts on different topics. Aside from the business cycle, we got one on the markets, on interest rates, the Fed, several other topics. And my goal is more to translate it, what it might mean for investors, what other things to point for. One of the downsides of Nick preparing them is that he is in charge of the sort of charts we show. And so I sometimes jump around a little bit and reference other charts as well. That said, keeps you on your toes, and I try to keep it interesting. So with that said, here the chart, why is the business cycle important? Why do we do this? And that's obvious in some ways. Is stock markets, risk markets, as they're referenced sometimes. Risk markets go beyond stock market, but stock markets have historically done substantially better during periods of economic expansion. The one caveat to that is, or several caveats. One is that we often don't know whether a recession has happened until after it's been formally announced, sometimes even after the recession is even over. We only know that there was one. And the other one is, and I like to point that out, in 1987, we had a crash and we had no recession there. And so those are important things. And then, of course, who knows whether history will repeat itself, but being cognizant of history tends to be a good thing, I would think. And a lot of what we do in this chart and together with the other charts is to just show where we are in the business cycle. And now, aside from the stock market, we put a lot of work at Merk here on interest rates. And not just because of the currency work we do, but also because one can take positions on interest rates directly. One has to use derivatives. If anyone ever wants to do that, feel free to reach out to us. We can help you do that. At least not everybody, but there are some people we can help doing that. We unfortunately can't cater to very small accounts, but if you run a family office or have a larger portfolio, we might be able to assist with you. And if there's a lot of demand from small investors, we might be able to put together something else as well. But I'm getting ahead of myself here. And leading economic indicators, as you see on this chart, is something that's well publicized in the news. The short of it is that often leading economic indicators have had a recession dip down. They are doing just fine. Momentum might be slowing and so forth. Part of the theme you're getting here is that we're in the later stages of an economic recovery, economic expansion. I'm not telling you anything you don't know at this stage. The steepness of the yield curve has been in the news quite a bit. That's the relationship between shorter term and longer term yields. You can use different durations here on the yield curve. Here you're seeing the 10-year yield versus the 3-year yield. And that might be inverting soon. Now, a lot of people say that, hey, when the yield curve inverts, there's going to be a recession. Some folks at the Fed have indicated that they would not hike rates if they were knowingly inverting the yield curve. And by the way, this is the 3-year yield that's already pricing in some rate hikes. So just because we are raising by another 25 basis points doesn't mean that if we are currently at 16, at the difference that what's necessarily going to invert. Couple of things. One is it is a necessary but not sufficient condition, at least historically speaking. And that the yield curve inverts ahead of a recession. And obviously there can be a lag here, as we can see here on the a decade ago, a little over a decade ago as well. But you can get false signals. And more relevant for the Fed, those regional presidents that have indicated they may not want to invert the yield curve, that is not the Fed mandate. It is just an indication that monetary conditions are getting tighter. And there's a reason for that. The reason why monetary policy gets tightened is because the Fed wants to make sure that the economy doesn't overheat, causing a more severe recession down the road, causing too much inflation, and so that they can stay within their mandate. And as we have shown, and I don't quite know yet whether we have that on these charts, financial conditions, yes, I think we have it. Financial conditions are just fine, meaning the Fed rate hikes haven't really had the impact yet. Now, obviously, we've had some impact in emerging markets, as many of you are aware of, but U.S. markets, the U.S. economy has not really felt the kind of the bite of the Fed, the tightening, because there hasn't been tightening. We're still in accommodative mode. We're still below the quote-unquote neutral rate. Keep that in mind with an economy that's going gangbusters. Here we have the Purchasing Manager Index also reaching highs here. Things are doing great, and according to those metrics anyway. Global Purchasing Manager Indices. There was a lot of talk in recent months how some purchasing manager indices have been slowing down. Germany, by the way, is this blue line that had been trending down. One of the metrics that's not on here that was below 50 is Norway. That has popped back up above 50. Can't show all the PMIs here. And above 50 signals economic expansion. And so obviously, if you're in the late phase of economic expansion, it's not too surprising to see some reduction of the momentum, I'd call it, rather than a slowdown. And that's, again, if you translate it to other things, what is the most relevant thing? Is it the most relevant thing that we can pinpoint when the next recession is going to hit? Or is it that we're going to pinpoint when there's a top of the equity market or the top of the hiking cycle? It really depends on what you are an investor. And so giving here a little bit of a holistic picture, I think might make a lot of sense. Unemployment rate obviously has come down quite substantially. The reason we show a moving average here is that signals potentially a change in trend. That is not happening. The San Francisco Federal Reserve also has a model on the unemployment rate. I'm going to skip that here. Capacity utilization. Now we're getting into the area where there are signs that we might have an overheating economy. I just pointed out earlier that the Fed might want to ensure the economy is not overheating. Now, clearly, just one indication that there is one index that suggests that, well, maybe we are running at above capacity is not the quote-unquote end of the world for the Fed, but it's not the only one. There is another indication here. The Congressional Budget Office has a potential GDP that they announce. According to that metric, we're also running above capacity. And of course, reasonable minds will disagree on some of the details on how these metrics are constructed. So they're just reference points. Now, my take is that this is all happening on the backdrop of an economic stimulus. And this is happening on the backdrop of very low unemployment. Now, clearly, there have been some people from the sidelines that have been joining the labor force. But in my view, there are increasing signs, most notably wage pressures, that are gradually but significantly increasing, suggesting that this economy is getting ever tighter. It's economic expansion. On that backdrop, we recently, just a week ago, as of my talking here, had another indication that the GDP growth is doing just fine. And again, that means we're going to use up more of the resources that are on the sidelines. And so what you do if you control interest rates, you kind of want to take the foot off the accelerator. And while rates have been going up, we're still on the accelerator. We're just pressing down less hard. And in my view, the question is that appropriate? And I guess you can gather from how I phrase that question that it may not be appropriate. Now, other metrics, though, are saying, hey, this is going great, right? I mean, consumer delinquencies are down quite substantially. So the consumer is far less levered than he or she has been in the past, at least in this economic cycle is concerned. And so again, things are moving just fine. Consumer confidence is doing great. We're not at the peak here that we were in the late 90s, but consumers are quite confident. They have a job. Here, this is one indication of whether the rate hikes have an impact, and at this stage, no. And that's not so uncommon that in advanced stages of an economic expansion, the banks want to participate, right? They want to make money, and so they want to provide loans, and it's exactly for that reason why the Fed then wants to tighten. This is the chart I was referring to earlier. High yield spreads, it's one of the main indicators of whether financial conditions are tightening. This is the so-called junk bonds, what they are yielding versus treasuries versus the so-called safe asset. And there are, if one looks around, obviously there are some pockets where you're starting to feel some strain. I mentioned emerging markets earlier, and some people are pointing out it's kind of gradually making it from the kind of the most vulnerable place, emerging markets, and then eventually we get to the high yield market, and then to the equity markets, where we're going to then see some turmoil. All those are quote unquote risk assets. Risk assets are assets that have a cash flow to varying degrees, and a risky cash flow most notably. And as interest rates move higher, well, you're going to discount those assets more, and it's going to make it more difficult for those that need access to financing to obviously have access to credit. But this is kind of proof that at this stage, these rate hikes and the quantitative tightening hasn't had an impact yet that is of any significance to what really matters in the context here of the US business cycle. It may matter very well if you are in Argentina and trying to raise money, but it doesn't matter on the high yield spectrum. In the US, the lower end of the investment grade corporate sector has had some strain. That's been in the news by some people. I attribute that mostly to the type of investors that buy these may well prefer a quote unquote safe treasury security, because there you take on interest rate risk there, but you're not taking on the credit risk of the issuer, because the U.S. government can always print itself out of trouble if they really wanted to. Whereas why only get a little bit more on the lower investment grade corporate sector? And then here on the high yield side, you're taking pretty much a jump further. That's a different type of investor that embraces the riskiness of the corporate sector. And so there we haven't seen any noticeable tension. Obviously, there's one or the other issue that's been in the news where that can happen. And so Nick puts together this checklist here, and using a different metrics, trying to come up with a assessment. And note here that in several of the charts, Nick is pointing out the risk of a recession within the next 5 years. Now, he does that based on kind of the historic analysis. Obviously, for many of us, 5-year outlook is maybe a little bit difficult to comprehend for this business cycle. I personally have my doubts that this expansion is going to last for another 5 years. But who knows? I have an open mind and will revise my opinion. My base case scenario right now is that we have too much stimulus in this economy. At the same time, the negative side effects are only gradually becoming apparent. Now, we have a Federal Reserve that's taking a step-by-step approach, which means a quarter rate hike every other quarter. Every other meeting, which is once a quarter. And to me, that suggests that they have to keep marching on for an extended period, which means we'll have all the 4 rate hikes this year, and we might even get 4 rate hikes next year. If anything, there is a risk that they have to accelerate that at some point. and of course, there's going to be some political backlash if that were to happen. The market does not price in that much, and so the market is pricing in less than 4 rate hikes this year, and is also not pricing in as much for next year. And so we spend a lot of time looking at these things, and then also taking positions on that, simply because we think that there is a potential profit opportunity to be had. And I just pulled it up. So 3.74 rate hikes are priced in for this year, including the ones that we've had already, which means 1.74 more rate hikes of 0.25%. And then for next year, we're pricing in less than 2 rate hikes, 1.64 rate hikes. So that's less than 0.5%. To me, that's way too low. And if you think about what that means for the markets, it means that volatility should increase. And I say that because in my book anyway, as I indicated before, as rates go higher, you have these risk asset cash flows being discounted at a higher rate. What that means is that active management, in my view, is going to come back. Now, that doesn't mean everybody's going to embrace active management, although if you have thousands of indices, nobody's really that passive. But still, there will be winners and losers. Because the higher rates will have an impact when credit is free, quote unquote, everybody survives. But when credit is no longer free, the bad apple, so to speak, will have an issue, will potentially have a problem. As long as the earnings momentum is there, that might be just fine for the equity market. That said, investors will increasingly diversify because as interest rates move higher, well, cash is yielding what might be acceptable to an increasing number of people. They just don't want to deal with all the other stuff that's around it. And then if you just take it a step further, at some point at the peak of the economic cycle, and that's one of the key things that we are watching when that is, we think that there is a trading opportunity on the downside, because usually at the peak of the economic cycle, investors are not pricing in rate cuts to the extent that they will happen. Odds are high that we go back all the way to 0. And of course, the higher we go, the bigger the potential is on the way down. And so anybody who wants to learn how to potentially take advantage of those sort of things, reach out to us and we can see whether we can be of service in that. And let me see, I should show you these concluding thoughts. Those are the ones from Nick. My own thoughts I just gave to you. Overheating is really the biggest threat right now in this economy. And of course, we can't give specific investment advice here, but if one takes the position that equity markets do better during economic expansion, one can continue to be in the equity markets, but keep in mind that a lot of investors have not rebalanced. And of course, the later you are in that economic expansion, well, the bigger the risk is that you're going to go kind of be on the other tail end of it. At the very least, I believe investors should consider rebalancing. And then, of course, yes, please read the disclosure. Now, before I wrap it up, we do have a premium chart set as well. And Nick is preparing that. And in this particular month, Nick put together several, I think, very, very good charts that at least I appreciated a lot, but they are behind a paywall. So I'll ask you to go to merkinvestments.com/research to enjoy those. With any of this, as always, please provide us feedback. This is still a quote-unquote service product that we're developing. Let us know how you like this research service. Let us know how do you like the format, whether you like to change it. We are experimenting a little bit with slightly different formats, and please bear with us. But hey, I hope you have some use for these and share them with your friends and point them to come to our site to get the latest on our research. Thanks, and have a great day.